Market volatility has absolutely nothing to do with the Trump administration and everything to do with the monster imbalances created in the past years. We have been saying for a few months that the United States private sector was already in a very weak environment. Real wage growth was negative. We saw how the small business confidence was very weak as well. Additionally, what we are seeing as well is that the earnings of those smaller companies were also quite weak. All of those elements of a private sector recession were already there. What have we witnessed in the past 4 years? A monster increase in government spending and a monster increase in debt and deficit, and also government hiring. Almost 1.5 million new government jobs in the past 4 years. All those things paid with higher debt. Now, in order to control inflation and in order to control and adjust public finances, government spending needs to be reduced. However, that may have a small impact on GDP because GDP can be bloated with government spending and debt. That is not a negative. Reducing government spending, reducing the fiscal imbalances, and reducing government hiring is not just not a negative for the economy, it's actually strengthening the private sector and it's actually strengthening the productive economy. That will also lead to a reduction in inflation. The problem for the market right now is persistent inflation. What the market has realized is that the expectations of a rapid decline in inflation had no reason whatsoever. And we had already witnessed an increase in inflation expectations in the second part of the 2024 period. The Federal Reserve cut rates way too fast in a period of elections and in a period of enormous increase in government spending with very loose financial conditions. That is the cause of the current burst of expectations of inflation. If tariffs were the cause of inflation, China and the European Union would have hyperinflation. That is not the reason why the market is scared about inflation. Furthermore, if Trump's comments were the reason why the market is weaker, then obviously European government bonds would not have slumped to the worst level since 1990 in the case of Germany, but also the rest of the European sovereign bonds. They would have risen. So what is the European debt and global sovereign debt as well as markets telling us? That everybody is seeing that inflation is not a fatality, it's not a coincidence, but it is a policy. And that after a massive increase in government spending all over the world in the last year, what we're seeing right now is the consequence of it. And that means persistent higher inflation, which means lower number of rate cuts, which means lower probability of easing, which means market volatility. Therefore, we should be looking at inflation expectations, government spending, and debt, and understand, and we should really understand, that cutting government spending and cutting massive imbalances and deficit spending is not a negative for the economy. It is actually a positive.